Good morning. This is Horizon's Middle East and Africa. Our top stories this morning. Straight chaos. The U.S. Navy attacks and boards an Iranian-flagged cargo ship as the Strait of Hormuz remains closed, with Iran setting out a new fee. Oil and gas jump while stocks trade with caution after those fresh escalations in U.S.-Iran tensions and the continued standoff in the Strait of Hormuz. And Tehran vowing to respond as President Trump once again threatens to destroy the country's power plants and bridges, and Iranians saying no clear prospect for productive negotiations and that there are no commitments yet to attend talks with the U.S. Well, it's just gone 8 a.m. across the Emirates. I'm Jumana Versace in Dubai, back in the studio. Good to be here as we enter into the eighth week of this war. And of course, remember, the clock is ticking. The ceasefire does, in theory, expire tomorrow evening, early in the morning on Wednesday over here in the region. So all eyes on whether there can actually be a breakthrough with these diplomatic discussions, as we keep also and we pay close attention to everything that has happened on the Strait of Hormuz over the course of the weekend. A lot has gone down, including CENTCOM seizing that Iranian-linked vessel overnight. So what has the reaction been in markets this morning? Well, surprisingly, Asia-Pacific brushing off some of the weekend's developments, sticking to trading in the green. And of course, we had a lot of positive momentum in global equity markets towards the end of the week. Last week, S&P, NASDAQ record highs. The momentum is picking up in Asia as well, specifically around some of those Asian tech stocks. Asia Pacific up 0.6%. S&P futures dipping though this morning. We are pulling back a little bit. But I will say, interesting statistic on the S&P. This is the first time, so at the end of the week last week, that the index has rallied more than 3% for 3 weeks in a row. Back-to-back 3% weekly gains for the S&P. It tells you they're living in a completely different world from everything that's going on in the region, or at least pricing in the end of the war, which is a big question mark over here. Brent also, take a look at where we're trading today. Up 6%, almost 6%. And Friday, of course, we did catapult downwards after news came out that the strait had been opened, and then President Trump thanking the Iranians for opening the straits. And then, of course, over the course of the weekend, we realized that that wasn't the case. So oil, once again, quite volatile. We were back at around $95. We got as low as around, was it like high 80s, I think, by the end of the day on Friday. So we were down 9% at one point, up 5.5% today. And then European gas futures, again, no surprise, given the uplift that we're seeing to oil. We're also seeing a bit of an uplift to gas as well, up 5.8% this morning. And switching over, I want to draw your attention to dated Brent. And the reason I'm bringing this up is because the Iranian Speaker of the Parliament himself put up a post referring specifically to this particular contract and saying, keep an eye out on it. And, well, I thought that I would actually just chart it for everybody who doesn't have access to a terminal, just to show you that at one point, this is a physical barometer of Brent. And at one point we traded through $140 a barrel. Well, in the last couple of days, we've actually broken through $100 to the downside. We're trading at around $98 now. It's the first time we've broken through $100 since March 11th. So this, at least this chart specifically, is telling you that some of the physical tightness is being priced out of the market. Whether that actually translates to the real world is a big question, but there you go. Dated Brent trading below $100. Okay, let's also check in on how markets in Asia are faring. Avril Hong is in Singapore for us. Avril.
Yeah, Jumana, despite the spike in energy prices, we are seeing Asia stocks well in the green today, which is pretty remarkable given how, for much of the conflict, the conversation around Asia was dominated by how vulnerable this region was to energy supply shocks. But now investors seem to have made up their minds that the worst of the impact of the conflict on Asian economies, to some extent, is already behind us or already been priced into the markets. You think about how the couple of weeks ago, we already saw that bit of a valuation reset. So especially for the markets that are AI exposed, think Taiwan, think South Korea, they look particularly attractive. And all this is helping the MSCI Emerging Market Index to recoup all the losses that we've seen it clock during the conflict. And there's a couple of other things I would just note, including on how on the Korean won, you're still seeing it on the back foot today. It is leading losses in EM currencies. It's also lost by the most in more than a month. So to some, that also speaks to the need for the case for two-way trades, given the fluidity of the geopolitical situation. But as I said, Asia in the green for the most part today. Jumana?
Avril, thank you so much. Avril Hong in Singapore. Let's go back to our main geopolitical news. President Trump says the U.S. has fired upon and seized an Iranian-flagged cargo ship in the Gulf of Oman in the first major encounter in the week-old blockade. Trump said in a social media post that the ship, the Tuska, tried to get past our naval blockade and it did not go well for them. Meanwhile, Iranian news outlet Press TV says the country's military commands would respond to the U.S. action soon. Joining us now is Paul Wallace, Bloomberg's managing editor for MENA Economy and Government, and also with us is Stephen Sachinsky, who leads our Asia energy coverage. Stephen, I'm actually going to start with you. We've had so much drama around the Strait on Friday. We thought it was open, and then, of course, it got closed again, and then it was controlled, and then it was dangerous over the course of the weekend. And now we're waking up to news that CENTCOM actually seized an Iranian-linked vessel. Walk us through these developments.
Yeah, I mean, the weekend, it was like a Seinfeld skit, right? It's open, it's closed, open, it's closed. Just pick a side and go with it, I think was what the market was looking at. And clearly now it's quite closed. We saw traffic shut on Sunday. A day after traffic on Saturday was at the highest level since the war began. According to some estimates. So really, it's been a bit of a whiplash. But of course, now with Trump saying that they've taken that vessel and Iran saying that they're going to respond, you're likely not going to see very much traffic or even ships trying to go through at the moment. I look at liquefied natural gas very closely. I was monitoring 5 LNG ships that were getting quite close to the Strait from inside the Persian Gulf on Saturday. But then when there were reports of an attack within the Strait, as well as Iran sending out messages to ships in the region that the Strait was closed, you saw those ships U-turn or halt altogether. That's a big deal for LNG because not a single LNG shipment has been exported from the Persian Gulf since the war began in late February. But again, this is where we stand. I think the market is closely going to be monitoring how Iran responds, if they respond, and what this means for ships transiting that strait going forward.
Yeah. I mean, not just what it means for ships transiting, but Paul, what does it mean for the potential Islamabad negotiations that are supposed to take place this week? The White House saying that they're sending, once again, senior U.S. representatives to Islamabad for Tuesday talks. But could the events of the weekend torpedo these talks?
Yeah, I think they could. It's, as Stephen mentioned, it's extremely confusing at the moment what exactly is going on. The Strait is open, the Strait is not as open. You have the two sides ratcheting up rhetoric against each other at the same time, also talking about restarting the negotiations in Islamabad, in Pakistan. It is possible that we do see talks this weekend. Trump has spoken about J.D. Vance going to Pakistan for a second round of talks. But certainly what's happened now, I think it's clearly raised the tension between Iran and the U.S., and we could see that it's possible that these scupper the negotiations. From Iran's side, and we don't know the answer to this, from Iran's side, the biggest issue, at least in the last few days or since Friday when they said the Strait was open and when they initially said that, seems to be this U.S. blockade. Iran said the Strait is open for all commercial traffic, and it didn't insist initially on the U.S. blockade being lifted at the same time, but that remained in place, which was somewhat confusing. You know, why would Iran open the Strait if it hadn't got an agreement from the US that they were going to lift their blockade? But clearly they didn't. That blockade remains in place, and Iran is extremely upset about that. It's essentially saying we cannot open the Strait if our own traffic, i.e. traffic to and from Iranian ports, is still blockaded by the US.
Yeah, and they've also vowed to retaliate. So let's see what happens in the next 24 hours. Stephen, at the top of the show, I was just recounting the price action that we're seeing in oil and gas markets today. Again, a lot of volatility in the space. How are traders reading the latest developments? Because, again, of note that the physical market, and this is the dated Brent contract that I was referring to at the top, has broken through $100 for the first time since March 11. Are traders jumping the gun a little bit there?
You know, I think that it's interesting because when you look at the drop in prices on Friday, oil and gas, while they are higher today, they have receded quite a bit. They've pared some of those gains. And you're not really seeing a huge surge, especially the big jumps that we saw in March. And Brent is still below $100. Brent futures are also below $100 still. So I think that there is, obviously the situation is evolving quickly. The Strait of Hormuz still being shut. Bad for the market, no doubt. But I think there are two things that the market is monitoring very closely. One, maybe there will be a breakthrough this week if there are discussions about peace, if there is a meeting in Islamabad, if there is some sort of agreement, anything that can maybe ease this back into opening, maybe that is something that the market is monitoring. Also, second, and maybe more importantly, is that attacks on infrastructure in the region has essentially halted for about a week and maybe more, and that's really important because while the strait being shut, every day it's shut, that's 20% of seaborne oil and LNG that's not making its way into the market. If it were to open, a lot of that supply can come back rather quickly. The big fear and risk in this market is that if there's an attack on an offshore oil platform or one of the largest facilities in Saudi Arabia, suddenly it's not something that can be fixed in a few days and with ships kind of ramping back up. This is something that if repairs have to happen, it is weeks, months, even years. The LNG facility in Qatar, the world's biggest, 17% of that facility will be offline for 3 to 5 years, according to Qatar Energy, because of the damage that it got from an Iranian missile strike in the middle of March. So I think that's what the market is monitoring. And because those strikes have essentially halted and slowed down, and there's the tension, while rising, hasn't hit that level again, I think that's why you're seeing oil prices kind of recede a bit. But we'll see what happens going forward and as negotiations continue.
Absolutely. It seems like we're entering into yet again another pivotal 48 hours in the region. Bloomberg's Paul Wallace and Stephen Czersinski, thank you so much. Well, joining us now is John Sfakianakis, Chief Economist and Head of Research at the Gulf Research Center. Really good to have you with us. In your research report, there's one comment that stood out to me saying, the current Iran crisis underscores a familiar lesson of economic history. Great powers rarely enter wars constrained by resources, but they almost always become constrained by them in the end. How long do you expect this constraint on resources for the region and for the world to last, even if the war is resolved this week?
Well, thank you. Thank you for having me, Jumana. Well, it depends. In this case, we already see that there are going to be challenges. And what the market, back to your excellent question, what the market is expecting is a reprieve. The market is fatigued, it's tired. They're tired of listening to the issues, and they want to see an end to all of this. And that's why there is a huge disconnect between physical oil, which is trading today in Asia at $150, $160 a barrel, and spot oil, which is now $95. It's a bit up by about $5 since Friday, not a biggie. And as you said, and your colleague said, in Asia, things are looking not so bad. So markets are beginning to price an end to this. And the end is not only the opening of the strait, it's also the inability or unwillingness of the US to have a land invasion. That is really a critical issue. So as long as there is no invasion at hand and negotiations continue, the markets will say, well, it's coming to an end.
Do you think going forwards, because of this perhaps new precedent that has been set around the Strait of Hormuz, that there is going to be a push from the region, from countries around and near the Strait of Hormuz to find alternative ways to get their oil out that doesn't necessarily have to rely on the Strait of Hormuz. I note over the weekend the IEA chief, Fatih Birol, was talking about the need to build, say, a pipeline connecting Iraq to Turkey. We need to see more of those. Do you expect there to be a real push for a diversion of corridors here?
I definitely believe that everything is going to be on the table. The region has to think of alternatives, and one of them will be the pipeline extension of the East-West pipeline in Saudi Arabia. As you mentioned, the Iraq pipeline, also the Fujairah extension, that is definitely on the table. But also the world is looking at the Strait of Hormuz and saying, why should I be so dependent, especially the Asian countries? So the region will need to continue to double down and to promote itself as the logistical port and center of the world for energy, which we all found out it's quite important. We cannot find 20 million barrels just like this. And Asia is going to be looking at alternative resources and energy in order to be less dependent on the region. But definitely, everybody in the Gulf is going to be thinking, how do I get less dependence on the Strait of Hormuz?
Yeah. What about Russia? Have Russia emerged as the primary winner over here with the release of the waiver, the U.S. waiver on Iranian oil, the fact that they are selling at higher oil prices now, and the fact that there are many importers of oil around the world looking for alternative sources that aren't coming from the Middle East?
Yeah, absolutely. Jumana, it's an excellent question. Russia is a big winner. They're making now around $250 million a day, but also China is a big winner as well. And that is quite important, not only commercially in the Middle East, but also through their energy resources, their ability to withstand the difficulties of the energy crisis in Asia. That's very important. And also the strategic outlay. China is a winner. Russia is a big winner. Russia is going to extend its ability to produce more and cater. So that goes a long way for them. So, yeah, absolutely.
Just a final question for you. I know that there have been a lot of discussions around the world, the French, UK, talking about putting together a naval maritime force for once the war is over to secure passage through the Strait of Hormuz. How do you see that being implemented in effect? What does it actually look like to have this multinational coalition monitoring the Strait of Hormuz?
So let's be very fair and recognize that if there is an armada, a flotilla of vessels that monitor the Gulf, and it comes from NATO or, let's say, the European Union or Europe, in terms of the continent, that will be a very good thing because they do have the ability in terms of the frigates, in terms of the boat, the vessels, the right vessels, but also the demining capability. The U.S. has less so of a capability. So that is quite important. What I'm quite concerned is that there is a rift. There is a rift between NATO and the U.S. There is a rift between the EU and the U.S. And the EU does not see this crisis as their crisis, and they're limping along. And that is a problem. At some point, they need to put the effort in order to help out. I think that that is clearly the case. They cannot allow just the U.S. to be responsible for this.
John, really good to chat to you. Thank you so much for joining our show. John Sfakianakis, Chief Economist and Head of Research at Gulf Research Center. Let's talk about markets now. Traders are turning cautious after the latest flare-up in the U.S.-Iran war. Joining us now is Maurice Gravier, Wealth Management Group CIO at Emirates NBD. Well, whiplash, Friday afternoon to Monday morning. Things feel very different this morning. How can you trade in this environment? And I guess the lesson of the past few weeks is that it pays to buy the dip every time markets sell off, stock markets sell off.
I think it's just impossible to trade on the short term. I mean, traders are fast, but events are even faster. So it's about probably lengthening the time horizon. It doesn't mean that we cannot do some tactical asset allocation changes, which we have done. But it's not about trading the events. And when it comes to what happens, we see that as a kind of a normal development in a fragile ceasefire. But we keep on having constructive scenario that we work on about the current situation in the Gulf, and anyway on our investment horizon, which is multiple year, it makes sense to invest
in your notes, I believe you've put a 75% probability of a peaceful resolution and a 25% probability of, once again, further military escalation. And of course, we do have the ceasefire expiring in the next 24 hours. What do you think that translates to in terms of market expectations? Because I'm looking at where the S&P and the Nasdaq are trading, and for me, that's pricing in almost, 95% possibility of a peaceful resolution. So there must be opportunities that arise from your expected value versus where the markets are pricing right now.
Yes, absolutely, and you're very right. We look at the backdrop and then at valuations and even at behavioral factors, and it's a combination of that makes an allocation. To be very clear, we are slightly underweight on stocks from developed markets. We are neutral risk because we prefer emerging market stocks, but we are slightly defensive yet. When it comes to U.S. stocks, you're right. If you look at the prices, if you look at the valuation, I mean the PE from the S&P 500 has derated from, let's say, 23 forward PE to 19, and now it's at 20, and the earnings season that has just started, and you know better than me on the few companies that have reported so far, it's absolutely brilliant. So valuation-wise, it's not at all-time highs at all. And again, we are slightly underweight on US stocks. We look for opportunities that are elsewhere, that are probably pricing closer to our scenario.
What would incentivize you to get involved in US equities again? You say you're underweight. Are you just waiting for a resolution?
As you rightly say, US equities are living their own life and are probably pricing some favorable developments to which we put a probability. We agree with that, but there is not huge upside potential. Having said that, US stocks are our preferred region within developed markets because it's we allocate on developed and emerging. We prefer emerging, where China is our preferred region. Then within developed, we are underweight, but the US is our preferred region because of the earnings power of their companies, and the earnings season is working very well.
So aside from the war, there's another really big event coming up this week. There's the Senate hearing for Kevin Warsh, and that could be actually really market moving, because remember when his name came up, there was the expectation that Trump was going to replace Powell with somebody very dovish. But if you look at his track record, obviously he's voted slightly more hawkish, over the years. Do you think we could be in for a hawkish surprise coming through from Kevin Warsh this week? And if so, how would markets respond to that?
Well, we when it comes to the Fed and the monetary policy, we try to look beyond the people in charge. We try to look at the fundamentals and the reasons to act. And our scenario is still for at least one rate cut this year. One rate cut this year because, of course, inflation that is driven by oil is particularly pernicious because it's broad. It percolates into everything through transport, petrochemical, fertilizer, you name it. Having said that, in our scenario, we think that we are going to go through that, and at some point, the question will be on the strength of the labor market, and we think that the Fed would rationally, regardless of who is in charge, rationally consider cuts rather than anything else.
Okay, and one of the other phenomena that has occurred is a change in the dynamic of the dollar. Last year, we spent a lot of time talking about de-dollarization, investors looking for other safe haven assets. But actually, throughout the course of the war, the dollar has responded, for the most part, until recently, how you would expect it to. In times of geopolitical uncertainty, money did go into the USD. Does that change, assuming we get a resolution this week?
Definitely, yes. We actually issued a kind of, not really a playbook, but our view was that during escalation phases of geopolitical trouble, the US assets were better, starting with the dollar. In the de-escalation phases, we believe that we go back to this, what is probably a secular trend of rebalancing of global power that is not favorable to the dollar, but more to gold, emerging market assets. And we talked about an era of efficiency ending and an era of scarcity starting. We believe in commodities and in commodity-driven economies for the long run. But when you have geopolitical escalation, of course, it's about the dollar and it's about US assets. Yeah.
What about gold here? Gold has not performed as we thought it was going to.
Yes, absolutely. Gold was very interesting because we took profits on gold in early March when the geopolitical situation flared up. We cut emerging market stocks and gold way above 5,000. We still believe a lot in gold over the long term. We bought it back last week, actually, and we have a fair value of 5,200 for the end of the year. Secular drivers are here. The thing is that it was a bit hot and it didn't have this geopolitical...
You're not worried about emerging market central banks diversifying or just having to sell down their gold holdings to support the currencies?
It's interesting that you say that. We have seen Turkey sending tons of gold to defend their currency. And if you look at the price action, it was absorbed very, very easily. We think that there are still long-term buyers of gold, which is the currency you cannot print. It has value.
Yeah. Maurice, always good to chat to you. Thanks for coming in. Maurice Gravier, Group Chief Investment Officer, Wealth Management at Emirates NBD. Now for a look at some of the other stories we're following. The Wall Street Journal says the United Arab Emirates has begun talks with the U.S. for a financial backstop in case the Iran war plunges the country into further crisis. The report says the governor of the UAE Central Bank raised the idea of a currency swap line with Treasury Secretary Scott Bessent during a meeting last week in Washington. UAE officials are said to be concerned the conflict could harm its position as an international financial center, draining foreign reserves. Syria says it has stopped a cross-border attack from territory near the Israeli border that was planned by a cell linked to Hezbollah. The Iran-backed militant group denies the accusation, claiming it has no presence in Syria and accusing the Syrian authorities of fabricating stories to inflame tensions. Syria's government is hostile to Hezbollah, which fought alongside the forces of former leader Bashar al-Assad during the country's civil war. And a look at markets before we head into the break, as markets here, investors digesting all of the news over the weekend and the fact that ultimately the Strait of Hormuz is still closed, and not just closed, it's also dangerous as well. So S&P futures paring back some of the gains we saw on Friday, down 0.6%. Take a look at European markets too, down 1.2% as we head into the European session, and of course keeping a close eye on the price action in Brent and gas as well this morning. Both of those commodities seeing a bit of an uplift. Coming up, Israel's defense minister says the country's military has been instructed to use full force in Lebanon if troops face any threat, even during the current ceasefire. We'll bring you the latest next. This is Bloomberg. Good morning. This is Horizon's Middle East and Africa. Our top stories this morning. Strait chaos. The U.S. Navy attacks and boards an Iranian-flagged cargo ship as the Strait of Hormuz remains closed, with Iran setting out a new fee. Oil and gas jump while stocks trade with caution after those fresh escalations in U.S.-Iran tensions and the continued standoff in the Strait of Hormuz. And Tehran vowing to respond as President Trump once again threatens to destroy the country's power plants and bridges. And Iranians saying no clear prospect for productive negotiations, that there are no commitments yet to attend talks with the U.S. It's just gone 8:30 a.m. across the Emirates. I'm Joanna Bersace in Dubai. So the Strait standoff continues and indeed dramatic escalation of events over the course of the weekend there, with this morning CENTCOM saying that they had actually seized and boarded an Iranian-linked vessel. And again, no clear commitment from the Iranian side at this point that they are planning on attending those Islamabad discussions later this week. So lots of question marks as we start off this week, and perhaps explains a little bit of the cautiousness that we're seeing in S&P futures this morning. Those futures are down 0.6%, but not the case for Asian markets. There, the handover pretty solid, up 0.5%. We'll get through that in just a moment. But the bottom line here is looking back at Friday, the price action there, one of exuberance. As I was just saying earlier on in the show, this is the third week in a row that you've had the S&P gain more than 3%. It's never happened in history. So very, very strong performance from equity markets. And it's not just the geopolitics. So far, the earnings season is shaping up to be quite robust. And that's giving a little bit of boost for sentiment. The outlook still resilient despite many of the geopolitical hurdles in the first quarter of the year. Brent, also take a look this morning. Oil is up 5.7%. Similar case for gas as well, up around 6%. And again, their markets paying close attention to what has been happening on the Strait. The fact that supply disruption is still there. There's still hundreds of trapped vessels sitting in the Persian Gulf, and a real lack of visibility about when exactly the Strait of Hormuz is going to be free and unconditionally open for shipping. We still don't have visibility on that time horizon. I will just point out, though, and let's switch over, this is a chart of dated Brent, i.e. this is Brent that is going to be physically delivered at a near-term point. And the reason I'm bringing this up is because we spent a lot of time talking about the wedge between futures and physical market pricing. And what's interesting here is for the first time since March 11, we've actually seen Dated Brent drop through $100 a barrel. We're trading at around $99, so only just below $100. And it's still very elevated versus where we were before the war started, of course. But it does tell you that perhaps the market is pricing in imminent easing of pressure on some of these physical supplies, physical barrels. But again, it's questionable because at this point, the strait still is effectively shut. And so perhaps you could say the markets are jumping the gun a little bit, especially with so many industry leaders sounding the alarm bells still about the knock-on effects that these higher prices and the lack of supply availability on the market is going to do down the track to physical supplies. And also, just one thing I want to say is that the Iranian Speaker of the Parliament, Mohammad Ghalibaf, actually tweeted about this particular indicator overnight. So I thought I would just flag it, given it is on everyone's radar. All right, let's also check in on how markets in Asia are faring. Avril Hong is in Singapore for us. And Avril, I was just saying that there's some cautiousness as far as U.S. equities are concerned, but not the case for Asian markets today.
Yeah, it's quite a different picture, especially if you consider how the spike in energy prices, and we've been discussing this throughout the conflict, the vulnerability of Asia's economies to the energy supply shock. So what you're seeing on the screen, this green is quite remarkable. The idea that markets maybe have already priced in the worst of the impact from the conflict, and given how valuations had reset during the war, that makes some of these markets that are AI heavy look especially attractive. So you're seeing Taiwan, Korea leading the pack today, although I would just say they are currently paring some of the gains from earlier on in the session. And they are also worth noting, you're looking at the MSCI Emerging Market Index actually having clawed back and erased the losses that it clocked during the conflict. I would just highlight as well what we're seeing in currencies. In the Korean won, it is leading EM currencies lower. You're also seeing it lose by the most in, I think it's more than a month. So again, to some, this speaks to the idea of how maybe you need the case for two-way protection, two-way trades amid the fluidity of this geopolitical situation. But this is quite a different picture, to your point, to what we're seeing in U.S. futures. Jumana?
Yep, fluidity of the geopolitical situation. You're bang on with that. Avril Hong in Singapore, thank you so much. Well, Israel's defense minister says the country's military has been instructed to use full force in Lebanon if troops face any threat, even during the current ceasefire. The comments come as Israeli forces continue operations along the border. Bloomberg's Dan Williams joins us now from Jerusalem. Well, Dan, Friday, the ceasefire went into effect, but there have been a few incidents throughout the course of the weekend in South Lebanon. Just bring us up to speed and whether actually the Lebanon Hezbollah-Israel ceasefire is beginning to fray.
I wouldn't say it's beginning to fray. It does appear to be holding, at least for the week or so left on the clock. Remember that this is a 10-day ceasefire agreed between Israel and Lebanon. Hezbollah is not a party to that ceasefire. It's the elephant in the room in terms of a group that certainly Israel, but perhaps more tacitly the Lebanese government, would like to see defanged and removed from the equation. An Iranian-backed ally, which really opened up or reignited that second front a day into this U.S.-Israel war on Iran. There were lethal incidents over the weekend, as you noted. Israeli strikes on what the Israelis said were threatening Hezbollah movements. 2 Israeli soldiers killed by booby-trap bombs apparently left by Hezbollah before this ceasefire went into effect. However, it does appear to be holding, and it's worth remembering that, as published by the U.S. State Department, Clause 3 of the ceasefire agreement has use of force provisions for Israel, allowing it to take action against perceived or imminent threats by Hezbollah. So it would appear that for now, those actions are within the context and within the agreement.
Dan, what has been the Israeli public response to the broader regional ceasefire, these potential upcoming peace talks with Iran, and the fact that there are no Israeli officials included in these actual talks, alongside the ceasefire that was announced and you could say imposed on them by the U.S. towards the end of the week last week. What has the response been?
The Israelis are waiting to see, like much of the world, it would appear. They say that they're regularly updated by the U.S. administration. There's no reason to doubt that. But given the fluidity of the situation, we had over the weekend, within the space of 24 hours, announcements about the reopening and the renewed closure of the Strait of Hormuz. The U.S. president, as is his wont, makes fairly scattershot public remarks about the prospects for ceasefire talks with Iran to be continued, or, for example, a resumption of full warfare. To hear the Israelis tell it, they're ready for either eventuality. It's an important week in Israel. Tonight is Memorial Day for fallen soldiers. That's followed back to back by Israel's Independence Day, nationwide celebration, perhaps more muted this year than in previous years, given the fact that the situation's been clouded by that war, its inconclusive state as of now, and the fact that everyone, I think potentially including the Americans and the Iranians, are unclear about what the immediate future holds. The official posture here is that, for now, national security is assured. The Israelis have called off all the restrictions on public gatherings that had been imposed during the war to prevent or preserve civilians from Iranian missile attacks and Hezbollah rocket attacks. They are preparing for those national days. However, the country remains on a war footing, and to hear the government tell it, they would be prepared to resume war at very short order if that's what decided by the senior partner in this war, the United States.
Dan, thank you so much for walking us through the latest. Dan Williams. Now for a look at some of the other stories we're following. Turkish newspaper Hürriyet says the International Energy Agency has proposed building a new oil pipeline linking Iraq's Basra oil fields and Turkey's Mediterranean oil terminal in Ceyhan. Executive Director Fatih Birol reportedly believes a Basra-Ceyhan pipeline would boost regional and European energy security. He's quoted saying that financing issues can be overcome. Egyptian developer Talat Mustafa Group has announced plans for a $27 billion project called The Spine, a new city on the outskirts of Cairo. The development will feature 165 residential and commercial towers across 2 million square meters. The project aims to boost the Egyptian economy by creating over 155,000 jobs and attracting millions of annual visitors. And coming up, the IMF says the Democratic Republic of Congo is set to become sub-Saharan Africa's 5th largest economy this year. Our conversation with the country's finance minister next. This is Bloomberg. The IMF says the Democratic Republic of Congo is set to become sub-Saharan Africa's 5th largest economy this year, driven by a mining boom and a stronger currency. The country's finance minister told us reforms and investment are also helping drive growth beyond the resources sector.
26 year, we are predicting with IMF a rise of 6% of non-mining GDP growth. So the balance that we're bringing in is going to help to put added value chain, creating more jobs for our people and taking them and bringing them out of the poverty.
Where does that come from, that non-mining GDP growth, and how do you support that?
Yes, it comes from service to BTP, the infrastructure. The government itself is spending a lot on infrastructure. As you may be aware, we are a huge country with a huge potential. And we are in lack of electricity, lack of infrastructure. So we are funding this infrastructure. And also, as you may be aware, FDI up to 60%, as I said. And service and BTP infrastructure are the key sectors that are driving the non-mining GDP growth.
So there is still a need, though, for more investment into some of these projects in order to support that non-mining GDP growth. Does that come, again, from tapping the Eurobond market?
Yes, all of these resources that we're going to use I mean, we're going to be finding hydro plant, key and critical infrastructure. So this is going to help us moving forward. I mean, I can tell you, critical minerals are strategic asset for DRC. But resilience comes from what we build around this critical mineral resource. And this is what we've been doing since 2019.
And Minister, maybe just finally, investors still, of course, are a bit concerned about what we've seen in eastern Congo with the fighting that has gone on for decades. How much of a concern should that be for investors? How much has that factored into the discussions that you've had this week?
The consistency of policies that we're putting in place, the macroeconomic performance are assuring investors. Security concerns are there, but what is more relevant for them is what we're doing in keeping reforming the country, in keeping improving governance and tightening fight against financial crime.
That was Congolese Finance Minister Doudou Fwamba Likunde. And for more, we're now joined by our Chief Africa correspondent, Jennifer Zabazaja, who conducted that interview. There seems to be momentum behind the DRC right now. I guess the question looking ahead is, how sustainable is this growth momentum?
Exactly, Jumana, especially if you point to some of those statistics that you were just pointing out, which we heard from the IMF, which is that the DRC is going to overtake Ethiopia in terms of the growth of the economy. So, yes, there does seem to be a positive growth story for the country right now, especially if you consider what they had been through over the past few years. We heard that from the finance minister. Supporting some of the growth has been, of course, the mining sector as the world's top cobalt producer and the second largest copper producer. But really what the minister continued to reiterate to me during our discussion was that the government is really set on continuing to build out some of the non-mining sectors, and that is where they see potential for sustainable growth. He mentioned that foreign direct investment has actually increased 60% since 2019. You heard him there referring to some of the reforms that we've heard from the government, and some of the investment that they're seeing that go into and that they're focused on are things like hydropower and transport. And so, yes, mining has, of course, continued to support some of the growth of the economy, but from an investor perspective, what might help continue to make it sustainable in the long term is diversifying outside of just mining. But still, the real concern, and he mentioned this here, and I think it's still worth noting, Eastern Congo is a real security concern for investors. We have seen the government put in some of their own initiatives in order to address this, but still, it remains sort of the cloud over what is still a positive growth story in East Africa.
And Jen, given that it was a crucial week at the IMF, the regular DC meetings, Senegal is also top of mind. Has there been any progress with the talks between Senegal and IMF on the program?
Right, and we should remember why it is top of mind, Jumana, and that is, of course, because we did see the last facility that Senegal have actually being postponed or broken down because of what was found by this new government, which was about a $7 billion hole that they allege was from the previous government. So a lot of focus for the investment community has been, what does the path ahead look like for Senegal, which has, for many investors, looked like really a positive story when you look at it from the West African perspective. What we did hear from the IMF Africa Director Abibi Selassie was that talks have actually been going quite well. Of course, there has been quite a bit of volatility that has complicated deliberations for a potential new program, but he spoke to Bloomberg and told us that it's seeming like talks are progressing, and he feels like the government has actually been quite transparent in terms of financial stability in the country and where things look like moving forward. The real question, though, is what does that mean for a new program for the government? We don't yet know the outcomes of that, but at least telegraphing that they are having positive discussions seems to be a positive step for the country, considering where they were at not too long ago.
Jennifer, thank you so much. Jennifer Zabazaja, our Chief Africa correspondent. Now for a look at some of the other stories we're following today. The U.S. is weighing boosting uranium imports from Namibia as rising demand from artificial intelligence drives a push for nuclear energy. Officials say the fuel will be critical to power data centers, with Washington also exploring ways to support increased production through investment and financing. Kenya is in talks with the World Bank for emergency funding to cushion the impact of the Iran war. The country is seeking support from the lender's rapid response option, which allows quick access to as much as 10% of already approved but undisbursed financing. Analysts say the funds could ease pressure on the domestic market and help preserve forex reserves. And coming up, it is a busy week of earnings in Europe. Investors will be watching closely as heavyweights across the food, tech, and banking sectors reveal their first quarter earnings. We'll have more next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Joumana Versace in Dubai. Europe's earnings season is in full swing. This week brings several key releases that will offer a vital health check on the region's consumer resilience and technological momentum. Joining us now from London is EMEA earnings specialist Chloe Millet. Chloe, good to have you with us on the show. So earnings season getting into gear this week in Europe. Let's start with some of the consumer goods companies. Danone, Nestle, both facing infant formula recalls, mounting inflation. What are we expecting over there?
Yeah, there's a couple of challenges there for those kind of big food companies. So as you mentioned, those infant formula recalls that are really going to likely dent those sales for the first quarter. But then the bigger problem is really, as you said, those inflationary pressures, this increasingly weak consumer confidence because of the conflict in the Middle East. And so that means that for those companies, so Danone, Nestle, but Reckitt also reporting this week, it's going to be really about striking that right balance between pricing and volume and really maintaining those volumes in the face of that inflation and that weak consumer confidence. And so we could see maybe some sales misses, some revised guidance as well as those companies try and really assess what the impact is going to be throughout the rest of the year as well.
Yep, and European tech also in focus. We've got SAP, ASM, the semiconductor. What are we hoping or what are investors looking for out of those earnings this week?
Yeah, let's start with SAP because that doesn't look maybe as bright as some of those kind of chip-making equipment names. So for SAP, of course, business confidence has also suffered, just like consumer confidence because of the conflict in the Middle East. And so that might mean lower customer spend for SAP, and so maybe a little bit of a weak sales quarter. But then there's also those continued questions over AI disruption. Of course, we had this big software sell-off earlier in the year, and so investors are still very keen to know a little bit more about that AI question for SAP. And then on the other hand, for ASM International, for BE Semi, those chip-making equipment companies are potentially going to have a bright quarter following in the footsteps of ASML that we had last week as well, really benefiting from those growing investments in AI, but also benefiting from that semiconductor investment cycle broadening actually beyond AI and encompassing other sectors that need those chips. We also have ST Micro, which is a chip maker, also reporting and could have benefited as well from these investments in AI infrastructure. So that could be a little bit brighter on that chip making side.
And it's not just tech and consumer goods. We also have banks starting to report as well. Nordea, Handelsbanken are the first to report. What's going to be the focus there, given we're just coming off quite a strong U.S. banks earnings season as well?
Yeah, absolutely. So those Nordic banks are always the first to report in Europe. So we have, as you said, Handelsbanken and Nordea, and there the focus is really going to be on this net interest income. It's likely to be a little weak for the first quarter, and this lending income is going to be really the focus for the rest of those banks as well, because we have the prospect of higher interest rates that could potentially boost that lending income. But then on the other hand, weak consumer confidence potentially denting loan demand. So the balance between the two is going to be really key. And so we'll get a little bit of the first few signs of what that's going to look like for those European banks when we get Handelsbanken and Nordea.
Bloomberg's Chloe Millet, thank you so much for the preview. Lots to watch out for this week in terms of European earnings. Let's look at the market setup, though, ahead of the European Open. And things are trading with a bit of cautiousness today. Uncertainty about really what is going to happen in this part of the world, whether these negotiations in Islamabad are actually going to happen. Certainly, there was a lot of speculation mounting over the weekend that they were going to happen. But then at the same time, the showdown on the Strait goes on. So S&P futures down 0.6%. European markets down 1.2% as we head into the European Open. But that is it for Horizons Middle East and Africa. I'm Joanna Bersace in Dubai. Stay with me for Daybreak Europe. This is Bloomberg.